So good afternoon and welcome to this informational webinar on what to know about student loans restarted, hosted by U.S. Senator Bob Casey's office and the Institute of Student Loan Advisors, TISLA. We're grateful for everyone taking the time to join this call today. I want to start by introducing myself and the other panelists on this call. My name is Maria Hernandez, and I'm one of U.S. Senator Bob Casey's constituent advocates. Also on this call from U.S. Senator Casey's office is constituent advocate Kim Cochran. From TISLA, we are excited to introduce Betsy Mayotte and Addison Hoover. We're grateful for all of our panelists' willingness to join our office for today's webinar. Before we get started, I would quickly note that we will have a Q&A session via chat function available throughout the presentation. We ask that you please keep your questions general and short so that our panelists are able to respond to as many questions as possible throughout the course of this webinar. If you have any questions regarding your own specific situation or more in-depth questions, contact information for U.S. Senator Casey's office and TISLA's contact information will be provided during the presentation for you to reach out directly. At this time, I'm going to turn the call over to Betsy with TISLA to discuss specifics.
Thank you so much. And thank you to Senator Casey's office for sponsoring this webinar. This is really important information, especially right now, to get out to consumers. And I congratulate everybody that's on this call for taking the time to be with us today. I've been working in the student loan industry for over 25 years and have definitely found that the borrowers that take a minute to try to educate themselves about their options are a lot more successful in managing their student debt. I want to, and correct me if I'm wrong, I want to remind people that this is being recorded and it will be posted by the senator's office at some point after the session is over. I'm going to stop my video because my face is not going to contribute anything to this presentation. So just sort of lay of the land of what to expect. Today, we're going to start with an overview of the payment plans that are available for federal student loans. And then we'll do some examples of those different payment plans and how it might fit into your particular strategy. We'll talk about other options in case none of those payment plans should work, and then what to expect during this sort of on-ramp or payment restart period. Just a quick note about TISLA. The Institute of Student Loan Advisors is a nonprofit organization that was founded with the specific mission of ensuring that all consumers have access to free, expert, and unbiased student loan advice. So anybody can utilize our website. We don't require you to register or log in. You're not going to be barraged with any ads about student loan products. And then if you have questions beyond what I would like to think is pretty comprehensive, plain English information on our website, if you still have questions or need help, anybody can request free counseling via email. We don't do counseling via phone, unfortunately. That's very expensive to provide. But also, we think that getting our advice in writing is actually more valuable, especially with something that can be as complex as student loans. As was already mentioned, we encourage you to ask questions. We do ask that you hold off on your questions until after I've covered the particular topic that your question pertains to. If I'm doing my job right, I'm going to answer your question along the way. The other thing, I want to remind you that this session is being recorded, so you don't want to put a lot of personal information in your question, again, because it's being recorded and this is public, and you don't need other people knowing your business. If you do have a really complex question, again, we're available via email through the TISLA website. Every once in a while, I'm going to take a breath, and Addison's going to let me know if there's any questions that might be good for the whole group to hear. And of course, we'll be hanging around for a little bit after the session to address any questions that weren't covered. So with all that housekeeping out of the way, let's get into the repayment options. Now, federal student loans we have an embarrassment of riches when it comes to the sheer number of lower payment options that are available to borrowers. And so the downside of having so many options is that it can make things really confusing when you're trying to figure out what the best option is for you. So to try to simplify a little bit, there's basically two buckets of repayment options. There's the repayment options that are based on your income, and there's the payment options that are based on your balance. So, how high or how low your payment is. For the first bucket is going to be really exclusively based on what your income and family size is, and uh, the the payment options that are based on your balance is going to be exclusively based on what your balance is, not on your income or any expenses. So the most popular ones, the most talked about payment options these days are the ones that are based on income. And all of those plans are exactly the same except where they're different, which is part of what adds to the confusion. In fact, as you can see in front of you, two of the plans have exactly the same name, but they have very different requirements and terms. So I'm going to try to simplify these and sort of side by side them for you as much as I can. So under the income driven plans, now, by the way, when I say IDR or income driven plans, that's an umbrella term that we use for all the income driven repayment plans. IDR is not a specific plan in and of itself. Again, it's an umbrella term that we use if we're talking about all of the plans that are based on your income. So under the IDR umbrella, we have what we call old IBR, and that was the first income-based repayment plan that was sort of widely used. That's also the only income-driven repayment plan that both borrowers with federal family education loan program loans or direct loans are eligible for. As you'll see, all the other income-driven plans are only available to direct loan borrowers. Now, for those of you that go, well, wait a minute, I don't know if I have a FFEL loan or a direct loan. The simplest way to tell, there's sort of two simple tests. One is if you took all your federal student loans out after July 1st of 2010, then they are almost certainly direct loans. They stopped making FFEL loans, the Federal Family Education Loan Program loans, as of June 30th of 2010. Now, if you do have loans that were taken out prior to 2010, the vast majority of them were not eligible for the COVID pause. There were a few that were, but the vast majority of them were not eligible for the COVID pause. So if you took loans out prior to 2010 and you weren't, you were still getting charged interest during COVID and you were still due for payments, those are almost certainly fell. If you're still not sure, the best thing to do is call your servicer and ask, or log into your loan servicer's account. Most of them, except for Nelnet, will actually say in the loan type whether it's a FFEL loan or whether it's a direct loan. Now we also have new IBR. New IBR is only for direct loans. Pay as you earn is also only for direct loans. Revised pay as you earn, which is now also called the SAVE plan, is also only for direct loans. And then finally, we have income contingent repayment, or ICR. Now, ICR is the granddaddy of the income driven plans. It's technically the oldest one in that it was available as early as 1994. The reason that a lot of people haven't utilized ICR in the past is for a couple reasons. Number one, up until 2010, 90% or more of federal student loans being made were under that FFEL program. So they didn't have access to ICR. Number two, for most people, ICR actually ends up being the more expensive from a monthly payment standpoint of the income driven plans. Something else that makes ICR unique to the income driven plans is it's the only plan that Parent Plus borrowers are eligible for, and they can only access it if they consolidate their loans. Now, there is something that we like to call the double super secret consolidation loophole that's available to Parent Plus borrowers. And I'm going to talk a little bit more about that in a little while when we get to sort of the gory details of ICR. But for the most part, and especially after 2025, ICR is the only plan that under the income driven repayment plan umbrella that Parent Plus loans are going to have available to them, and only then if they consolidate their loans. I think somebody might not be muted. I'm hearing a little background stuff, so if people just want to double check their microphone, that would be excellent. Okay, so then we have the payment plans that are not based on income. They're exclusively based on your balance. Now, those include the standard repayment plan. Now, the standard repayment plan is the plan you get if, once you get out of school, you don't actively choose a different plan and you don't consolidate. That standard repayment plan, they base your payment on a 10-year term, and they give you a payment amount that's pretty much the same every month for 10 years, at which point you will have paid the loan off. If your balance is very, very low, say you only owe 5 grand, the lowest payment you can get on a standard repayment plan is $50 a month. So they're not going to drag a $5,000 loan out over 10 years. You'd pay $50 a month and you'd pay it off in less than that amount of time. Now, if you consolidate your loans and don't specifically choose a different plan, they also put you on a standard repayment plan. But instead of being a 10-year plan, it's between 12 and 30 years, depending on what your loan balance is. Pretty much, if you consolidated anything more than, say, 60 grand, you can expect a 30-year term. Now, one of the places where there's some confusion is for borrowers that are pursuing public service loan forgiveness. You are required to either be on an income driven repayment plan or a 10-year standard. And some people think if they're just on a standard plan, it counts. But remember, consolidation standard is not 10 years, it's between 12 and 30. And therefore, it doesn't count for public service loan forgiveness, other than under some temporary waivers that we had during COVID. The standard 10-year repayment plan for many borrowers is going to be the plan that costs them the least amount over time. I'm making a blanket statement that certainly isn't the case for all borrowers, but for borrowers who have, say, the average student loan balance nationally is about 37,000. For borrowers whose income is a lot higher than that, the 10-year standard plan is probably going to be what results in them paying the least amount over time. And that's the name of the game. We talk about all these forgiveness programs, and those can be very beneficial to borrowers. But the name of the game isn't forgiveness. The name of the game is paying the least amount over time. And for some people, that's going to mean pursuing a forgiveness program. And for other people, it's going to mean paying their loans off just under the 10-year standard, or even better, in a more aggressive manner to reduce the amount of interest that accrues. We have the graduated repayment plan under the non-IDR plans as well. Now, the graduated repayment plan has been around forever, and that's kind of self-explanatory. You're making interest-only payments for the first 2 or 4 years that you're under that plan, and then the payments gradually increase year by year. You still are going to pay the loan off under your whatever your term is, whether that be a 10-year term or a 12 to 30-year term. Um, so it doesn't extend the repayment. But the idea behind the plan is, hypothetically, most people when they first graduate, their income is lower, and then hopefully it increases over time. And this plan was intended to sort of go along with that assumption. Extended repayment is a way to extend the term of the loan and therefore lower your monthly payment without actually having to consolidate. That applies to borrowers who owe at least 30,000 in loans across the board. And again, you just have to apply for the plan and you don't have to consolidate, and it'll extend the term of the loan to 25 years, and you'll have the same payment every month, and pay it off within that 25 years. Now, all of these plans that you see in front of you apply to both direct loans as well as FFEL, and they also apply to Parent Plus loans without having to consolidate. As I mentioned before, none of these plans are eligible under public service loan forgiveness other than the 10-year standard term. Now, of course, there were exceptions to that because of some temporary waivers, but going forward, if you are pursuing public service loan forgiveness, you do need to either be on the 10-year standard plan or one of the income-driven repayment plans. All right, let's go back. Excuse me, I'm a little froggy today. Let's go back to the income-driven repayment plans and talk about how they work. So one of the things that they all have in common is they all base your payment on something called discretionary income. Now, discretionary income is a term that is defined under federal regulation. And I'm going to explain how discretionary income is determined. So a couple things that are the same among all the income-driven repayment plans is for married borrowers who file their taxes as married. They're going to, for discretionary income, they're going to use the total adjusted gross income for both spouses, regardless of whether they both have loans or not. For married borrowers who file their taxes separately, um, they are effective July 1st. They will only use the income of the actual borrower. Now that was different for repay prior to July 30th. Prior to July 30th, if you were on the repay plan, they used both incomes regardless of tax filing status. But effective on July 30th, it's the same across the board. Now, if you live in a community property state, they what they do is they take half the total income between the two, but that's again only if you're married and file your taxes as separately. So filing your taxes as separately can be a way to get an even lower payment under the income-driven plans, but you have to use that with caution and work out the other numbers because, of course, by filing your taxes separately, you could be losing out on some pretty valuable tax credits. So it could end up working out in the wash. So that's something you want to look at. If you're not sure the effect of filing married versus filing separately on your taxes, there are a ton of calculators out there on the internet that can sort of show you a side by side. You just Google it, and there's like 1,000 of those calculators out there. Pretty easy to find. So once you're looking at whatever AGI that they're going to be using, the plan that you're on depends on sort of the next step in this. The next thing they do is they subtract a percentage of whatever the poverty level is for your family size and state. So for income contingent repayment, they're subtracting 100% of the poverty line that coincides with your family size and state. For the SAVE plan, effective July 30th of this year, they're using 225% of the poverty level. And then for old and new IBR and pay as you earn, and the old repay, the pre July 30th repay slash save plan, they're using 150% of the poverty level. So just based on the fact of what percentage of the poverty level they're subtracting from your AGI, for most borrowers, that makes the SAVE plan the lowest monthly payment. Now, I say most because, as you'll see when we get to ICR, there's a weird little quirk in the ICR calculation that ends up for borrowers whose income is very high compared to their loan balance. Actually, ICR ends up being a lower payment than SAVE. But for most borrowers whose income is not significantly higher than their loan balance, the SAVE plan is probably going to be the lowest monthly payment under the income-driven repayment plans. And you'll see, I'm going to do a side-by-side and some examples as we go along. So try to get rid of some of these windows. I'm blocking my own slides for myself. Okay, so let's start looking at some examples so you can see how some of this works. So in this example, you have adjusted, the borrower has an adjusted gross income of 62,000. They're a family size of 4 and they live in Maryland. So if you look at for old IBR, new IBR, and pay as you earn, where they're using 150% of the poverty level for the borrower state and family size. So they're taking the adjusted gross income of 62,000. The poverty level for a family size of 4 in Maryland is 26.2. And so 150% of that works out to the 39.3. So you subtract the 39,300 from the adjusted gross income of 62,000, and that gives you 22,700. From there, they divide by 12, the number of months in the year, and that gives them almost $1,900. So under pay as you earn and new IBR, they're using 10% of that to determine your payment amount. So under new IBR and pay as you earn, the payment would be $189 a month. Under old IBR, they're using 15% of that. Now remember, old IBR is the only one that those old FFEL loans are eligible for. So under old IBR, the payment would be $283. Now let's look and see what the SAVE plan does in this situation. So remember, the SAVE plan is more generous. They're subtracting 225% of the poverty level for the borrower's family size and state. So that works out to $58,950. So they're subtracting that from the 62,000, which leaves a balance of a little over $3,000. Divided by 12, we get $254 and some change. Um, right now, under the SAVE plan, they're taking 10% of that for your payment for this year, which works out to $25.41. Next year, for undergraduate loans, they're only going to use 5%. So if we assume that this borrower has all undergraduate loans, their payment next year, assuming their income doesn't go up, is only going to be $12.70. So for borrowers with graduate loans, they're going to do 10% for the graduate portion and 5% for the undergraduate portion. So it essentially ends up being like a weighted average. And if someone has all graduate loans, the whole thing will be at the 10%. So if you remember, prior to July 30th, Repay/Save also used 150% of the poverty level. So pre-July 30th, someone on Repay/Save, their payment also would have been the 189. So now it's only going to be someone whose income hasn't changed. Their payment now is only going to be the 2541. So you can see what a really significant impact the SAVE plan can have for a lot of borrowers. Now, we're going to do some other examples and side-by-sides in a few minutes. But the other concept I wanted to put out there for you when we're talking about the income-driven plans is something called partial financial hardship. Now, this only applies to old IBR, new IBR, and pay as you earn. So under those plans, in order to get into the plans in the first place, your payment based on your income has to be less than what it would be under the 10-year standard repayment plan. So a PFH exists. So again, old IBR, they're using 15% of your discretionary income, 10% for pay as you earn a new IBR, and you're not required to have a partial financial hardship for ICR and Repay/Save. So regardless of how high your income is compared to your balance, you're always going to be eligible for ICR and the SAVE plan. Now, you don't have to have a PFH to stay in old IBR, new IBR, or pay as you earn. If your income goes up to the point where your payment would be the same under those plans as a 10-year standard, they're just going to cap your payment at that 10-year standard amount. Whereas with ICR and Repay, while you don't have to have a PFH to get into the plan, there's also no cap on the payment. So if your income goes way up, your payment can end up being a lot higher than it would be under the 10-year standard plan. Now, it's important to note that you can change plans at any time, but as you'll see in a little bit, they are sunsetting some of the plans, and there's going to be some situations where, once you leave a plan, you're not going to be able to get back in. So to show you an example of how PFH works, if we look at the example that we used on the prior slide where the borrower has an AGI of 62,000 and a family size of 4, if we assume that borrower owes 60,000 in federal student loans, their payment under the 10-year standard plan would be $720. Now, $720 is less than any of these payment plans. So whether it be new IBR, or pay as you earn, which is the 189, or old IBR, which is the 283, they're both a lot lower than the 720 So this borrower would be considered to have a partial financial hardship at their current income, and therefore would be potentially eligible for any of these three plans. Now, before I get into how this sort of wraps up with each individual income-driven plan, Addison, are there any questions that you think would be good to address with the whole group?
No, not as of yet, Betsy.
All right, thank you. All right. So now that we've explained sort of the ABCs of the income-driven plans, I want to talk about each individual plan, and how they work and how they could affect you, as well as the sort of other individual nuances they each have. Now, if your head's going to start spinning with this, and again, I don't blame you, because this can be really confusing. On our website, as well as the department's website, we do compare the plans side by side. Also, there's a really valuable tool on the Department of Education's website called the Loan Simulator tool. So if you're like, oh, I can't math and all these different rules are making my head spin, just tell me what plan I should pick. If you go to studentaid.gov and use the Loan Simulator tool, and I'm going to show you how that works in a minute, it's going to show you what your payment would be under each of these plans, just by pumping in your information just a single time. And more importantly, it's going to show you how much you're going to spend over time under each of the plans. So don't fret if sort of your eyes start to bleed a little bit with everything I'm about to throw at you. I'm going to do the best I can to simplify it. So let's start with old IBR. So again, old IBR is the only plan that FFEL loans are eligible for. Unfortunately, Parent Plus loans are not, unless they're double consolidated. And again, I'm going to talk more about double consolidation in a minute. Um, Both FFEL and direct loans are eligible for it. Old IBR uses 15% of your discretionary income. You are required to have a PFH, partial financial hardship, to enter the plan. Now, one thing about old IBR, and that you're going to see across the board for most of the income-driven plans, is that there is a little bit of an interest subsidy. And here's how the interest subsidy works for old IBR. If your payment amount on old IBR is less than the amount of interest that is accruing on the portion of your loans that are subsidized, now that would only be a subsidized Stafford loan, the government's going to forgive that difference in interest. So just for simplicity's sake, let's pretend all your loans are subsidized loans and you're accruing $100 a month in interest, and your payment under old IBR is $50 a month. For the first 3 years you're under old IBR, the government's going to forgive that other $50 in interest. And that applies even if you pay more than your required monthly payment. If your payment's $50 a month under old IBR, and you're accruing $100 a month in interest, so the government's forgiving the other 50, and you decide to pay $200 a month instead because you're trying to pay your loans down as quickly as possible, the government's still going to pay that extra $50 in interest, because it's based off whatever your calculated monthly payment amount is, not on what you actually pay. So that limited interest subsidy only applies for the first 3 years you're on any of the income-driven repayment plans. So in other words, you can't use your 3 years of interest subsidy on one plan, then go to another and get an additional 3 years of interest subsidy. So it's sort of like one and done. Now, the other thing the income-driven plans all have in common is they all have a forgiveness component baked into them. For old IBR, if you're on old IBR for at least 25 years, then they're going to forgive the balance after 25 years of actually being on old IBR, and that includes interest. Now, right now, the amount that's forgiven under the income-driven plans is not taxed. But unless Congress extends or makes permanent our current moratorium on the federal taxability of the income-driven plans past its current end date of 2025, the amount that's forgiven under the income-driven plans will be taxed as income if the forgiveness happens after 2025. And again, unless Congress extends that moratorium. I do encourage everyone on this call to write their members of Congress, especially as we get closer to 2025, and encourage them to extend or make permanent that moratorium on the taxability of the income-driven repayment plans. So new IBR is only for direct loans. Again, Parent Plus loans, unless they're double consolidated, are not eligible for new IBR. It's only eligible for borrowers who every single one of their loans was made on or after July 1st, 2014. Now, I want to clarify that a little bit. Most of the time, if you see a rule that bases your eligibility for something on your oldest loan, that's something that carries over even if you have older loans that you pay in full. So, for example, if you took your first loan out in 2013 and all the rest of the loans you took out after July 1st, 2014, you're not eligible for new IBR. But let's say you really wanted new IBR, and so you went in and paid off that old 2013 loan. Unfortunately, you still would not be eligible for new IBR because that 2013 loan will essentially have permanently tainted the rest of the loans. So it's truly for only borrowers where all their loans were taken out on or after July 1st, 2014. Now, they're not sunsetting new IBR, but if after July 1st, 2024, you want to get into new IBR, but you have already utilized at least 60 months under repay/save, they're not going to let you in to new IBR. And I'll explain why in a second. So, as a reminder, new IBR, they use 10% of your discretionary income. You do have to have a partial financial hardship to get in the first place. It has the same interest subsidy as old IBR, meaning 100% of the difference between your calculated payment and how much interest is accruing on your subsidized Stafford loans, or the portion of your consolidation loan made up of subsidized Stafford loans for the first 3 years. Now, forgiveness under new IBR is after 20 years on the plan. And that is the case whether you have undergraduate loans or graduate loans or a combination of the two. And this is also why they're going to start to limit who can get into new IBR. As you're going to see when we get to the SAVE plan, if you're on SAVE, the forgiveness, and I'm going to talk about this again when we get to SAVE, but when you're on repay/save, the forgiveness happens at 20 years if all you have are undergraduate loans. But if you have even $1 in graduate loan debt, the forgiveness becomes 25 years. Now, for the most part, you can skip around between the income-driven plans, but to avoid people sort of finding a loophole where they use SAVE for a long time to take advantage of the fact that it's a lower payment, but because they have graduate loans and want forgiveness in 20 years instead of 25, at the very end, they hop into new IBR. They don't want people to be able to do that. So if you can definitely switch from SAVE to new IBR if you're eligible for new IBR, but not if you've already been in the SAVE/repay plan for 5 years or more. All right, now pay as you earn is the fraternal twin of new IBR. All the rules are exactly the same. The only difference is the how old your loans have to be to get into pay as you earn. So remember, new IBR, all your loans have to be July 1st, 2014 or newer. For pay as you earn, you have to have no loans prior to 10/1/07, and you also have to have at least one disbursement on a loan on or after 10/1/2011. Now, if you don't fit that second criteria, but you fit the first, you can make yourself fit the second criteria of having a disbursement on or after 10/1/2011 if you consolidate. Now, pay as you earn also forgives all loans, whether they be graduate debt or undergraduate debt after 20 years. So they're actually sunsetting this plan effective July 1st, 2024. What that means is that if you're not actually on pay as you earn on July 1st, 2024, you can never get on it, even if you've been on it before. And after, if you are on pay as you earn on July 1st, 2024, and then leave it and get on another plan after that, you can never get back on. It becomes a one-way door, effective on July 1st, 2024. And if you're not on the pay as you earn side of that door on that date, then you can never get on it. And if you go back out, you can't get back in. Um, Again, pay as you earn is not for Parent Plus loans unless they're double consolidated. All right, let's talk about Save Plan. The Save Plan. The Save Plan is sort of the hot new plan on the block. Only direct loans, only Parent Plus loans if they're double consolidated. Um, the payment calculation, as a reminder, is 10% of your discretionary income, which is they're using 225% of the poverty level for discretionary income. Come July 1st, 2024, they're going to use 5% of your discretionary income for the portion of your loans that are undergraduate, 10% for the portion, 5% if all you have is undergraduate loans, 10% if all you have is graduate loans, and if you have a mix, they're going to do a proportionate percentage between the two. So for example, if you had 50 grand in undergraduate loans and 50 grand in graduate loans, you'd essentially be using 7.5% of your discretionary income to determine your payment. You're not required to have a PFH to get in, but of course that also means your payment, if you start making your income goes up to $5 million, your payment's going to go way up and can definitely get higher than what the payment would be under the 10-year standard repayment plan. Now, one of the big highlights, other than the 225% of your poverty level, but one of the sexy parts of repay/save is the interest subsidy. The interest subsidy was always more generous under repay, and I'm not going to go over the old rules because they don't apply anymore, but I did put them on the slide in front of you if you're curious. But effective this past July 30th, the government is going to forgive 100% of the interest on all of the loans under the SAVE plan, that is not that is more than what your calculated SAVE payment amount is going to be. And they're going to do that for as long as you're on the SAVE plan. There's no 36 months limit to it. So if you have a $0 payment, regardless of what your loans, what kind of loans you have, if you have a $0 payment under the SAVE plan, they're forgiving all of your interest for as long as you have a $0 payment under the SAVE plan. If you're accruing, $200 a month in interest and your payment's $100 a month, they're going to forgive the other $100 that's not covered by your calculated payment. Now, if you decide to pay extra, the amount of interest that's being subsidized will not change. I'm going to say this a whole bunch of times, and I'm saying it I'm repeating myself for a reason, because this is an area that causes a lot of confusion. The amount of interest that's subsidized for you under the SAVE plan is not based on how much of a payment you make. It's based on your calculated payment. So you can always pay extra and not reduce the amount of subsidy you're getting under the SAVE plan. Now, I think someone's off mute. So I don't know if the senator's office can find out who it is and mute them in the background. Thank you. So again, even if you pay extra, it's not going to reduce your subsidy. Now, one of the other myths about the SAVE plan is that it just forgives all your interest no matter what. And that's not true. If your income means that your payment is at least as much as the interest that's accruing every month, you're not getting any interest subsidy. So again, it doesn't forgive everybody's interest and all of it. It just forgives the amount that's not covered by your calculated monthly payment. Now, if your income is low for a very long time and you're under the SAVE plan the whole time, you can effectively, it's possible for some people to have a $0 payment and not pay a penny towards their student loans and get the entire thing forgiven. That's not going to happen to the majority of borrowers, but it is possible. Now, the forgiveness component for repay/save is 20 years if the borrower only has undergraduate loans. If the borrower has even $1 in graduate loan debt, the forgiveness is going to be 25 years across the board. Now, you are required to be on the same payment plan for all your loans that are eligible for that plan. So you can't, we get this question a lot. Can I use pay as you earn for my graduate loans and save for my undergraduate loans? And no, you can't. You have to be on the same payment plan for all the loans that are eligible for that plan. Now, one last feature of Save that isn't taking effect until next July, and this is another feature that's causing some confusion, and one where we don't have all the information yet. But if the original amount that you borrowed across all your loans was less than 12,000, so not 12,000 per loan, the total amount you borrowed is less than 12,000. The forgiveness is going to be after only 10 years on Save versus the 20 or 25. Now, let's say that you borrowed 13,000, then your forgiveness will be after 11 years. And that goes up for every extra 1,000 you borrowed until you hit the 20 or 25-year mark. So no one's going to have forgiveness after 50 years. The most it's ever going to be is 25. But if all you ever borrowed was the 12 grand in the first place, it could be as low as 10 years. Now, to be crystal clear on this, if you borrowed more than 12 grand in the first place, but paid it down to 12 grand or less, this does not apply to you. If you borrowed more than 12 grand in the first place, paid it down to 12 grand or less, and then consolidated, this does not apply to you. If you borrowed 12 grand or less and got on the Save plan and then borrowed more loans, your forgiveness time frame would go up. And again, so let's say you borrowed 3 loans of $5,000 each. This would apply to you only for the fact that you only borrowed 15,000. So your forgiveness component under Save Plan would be 15 years. No, sorry, 13 years. I can't math today. Under the Save Plan. So I'm guessing, Addison, that there's going to be a bunch of questions about this, and I'll check in on those in a little bit. All right, let's talk about ICR. ICR, as I mentioned, is the oldest income-driven plan. It's also the only one that Parent Plus borrowers can access with just a single consolidation. Unfortunately, for many borrowers, it can also be the highest of the income-driven plans. The exception to that being borrowers whose income is very high compared to your loan balance, in which case the payment amount will be often the lowest of the income-driven plans. For ICR, there is no PFH. There's also no interest subsidy. The forgiveness happens after 25 years. They're only using 100% of the poverty level, and then they're using 20% of your discretionary income, which is why for many borrowers it ends up being the highest monthly payment. Now, there is a little quirk in the regs here where your ICR payment is going to either be 20% of your discretionary income, or if it works out lower, and this one is a little harder to visualize mathematically, but they figure out what your payment would be under a 12-year standard repayment, and then they multiply that by what's called an income percentage factor, which is similar to the poverty level, but not really. It's something the Department of Ed publishes annually, and you can see an example of what that looks like in the link I provided here. If that payment amount ends up being less than what your 20% of your discretionary income would be, that's your payment amount. And that's where it ends up being, that's why it ends up being that borrowers who have high income compared to what they owe in student loans can end up with that actually being the lowest payment amount. Now, really quickly, I want to talk, I've mentioned a few times, double super secret consolidation. Unfortunately, it can be a little complicated to explain, so I do encourage you to go to the TISLA website, which is freestudentloanadvice.org, and go to the consolidation page. And if you scroll down, we talk about double consolidation in detail and give you step-by-step instructions on how to go about it. But if you have Parent Plus loans and you either really need the SAVE plan or one of the other lower cost income driven plans, maybe you're pursuing public service loan forgiveness, or the SAVE plan would really lower your payment. Essentially, if there's a loophole that if you can consolidate the Parent Plus loans twice, then they will give you access to the SAVE plan, and if you're eligible, the other income driven plans. So a really quick example, let's say you had 4 Parent Plus loans and you consolidated loans 1 and 2 together. Now you have a consolidation loan, 1 consolidation loan and 2 Parent Plus loans. And then you consolidate loans 3 and 4 together. So now you have consolidation A and you have consolidation B. So at that point, consolidation A and consolidation B are made up of Parent Plus loans that have only been consolidated once. You then consolidate those 2 consolidations together. Now you've consolidated the Parent Plus loans twice. So if you think of, this is an analogy that works for some people and not for others. If you consider consolidation to be a blanket, a very thin blanket, and the goal is to make it that you're hiding the Parent Plus loans. If you put one blanket over the Parent Plus loan, you can still see it because it's a thin blanket. You can sort of see the shadow of the Parent Plus loan underneath that blanket. But if you put 2 blankets over it, that's enough to make it so the Parent Plus loans can't be seen anymore. You can't see that shadow anymore. Again, if I've completely blown your mind here, go to the consolidation page on the TISLA website and scroll down and you'll see step-by-step instructions. Now, as a reminder for all the income-driven plans, they're using both incomes if you file your taxes as married. But on the flip side, if both borrowers also have loans, they're also going to take both loan balances into account. For many borrowers, filing jointly and both getting on an income-driven plan can be the way to have the lower payment amount for the household. But it's definitely something you want to run the numbers for using different scenarios, using that loan simulator tool on the Department of Ed's website. Another downside of filing your taxes separately is it reduces the family size that they use. If you file your taxes separately, you cannot include your spouse in your family size. And that's for all the income-driven plans. All right, so the forgiveness for the income-driven plans. Under the traditional income-driven plan rules, you do need to be on an income-driven plan for every one of the months of the 20 years or the 25 years needed for forgiveness under the various plans. So 20 years is 240 months and 25 years is 300 months. Now, they don't have to be consecutive. You can use a deferment or a forbearance or get on a non-IDR plan along the way. It's just that under traditional rules, those months won't count towards the income-driven plan forgiveness. Now, consolidating used to reset the IDR count to 0. However, there's a waiver in place called the one-time account adjustment. And under that adjustment, if you consolidate before December 31st of this year, the consolidation loan will eventually get whatever the highest count was of your underlying loans once they do the one-time adjustment. Now, they're not doing the one-time adjustment for most borrowers until next year. So if you consolidate it now, it initially would reset you to 0. But once they do the one-time adjustment, you'll get that back. Now, if there's a lot more information about that one-time account adjustment, and we do have a link to a broader explanation of that at the end of this presentation. Now, if you consolidate after December 31st of this year, they're going to do a weighted average of the underlying loans for what the consolidation count would be for the income-driven plan. So let's say you had undergraduate loans that have been on an income-driven plan a lot longer than your graduate loans. So your undergraduate loans, say, had 50, and your graduate loans had 0, and you consolidated them together. The consolidation, assuming you owed the same in both undergraduate and graduate, the consolidation loan would have a count of 25. Now, as I mentioned, you don't have to be on the same income-driven plan the whole time. You can jump between plans. Your employment status or who your employer is does not matter towards the income-driven plan forgiveness. And remember that any payment that counts as an IDR payment also counts towards public service loan forgiveness if you happen to be working for PSLF eligible employment. Now, there are a couple other statuses, and this is a recent change, that will count towards the IDR forgiveness. Those are periods, and this is, again, just effective this past July. Any period you were under a cancer treatment deferment, a rehabilitation training deferment, an unemployment deferment, military service deferment, or economic hardship deferment. And starting next year, they're also going to count forbearance periods if the forbearance was because you were in AmeriCorps, under bankruptcy, or certain types of forbearances that go on in the background that we call administrative forbearances. Beginning next year, there's going to be limited accessibility to some defaulted borrowers for IBR, but other than that, defaulted periods of default never ever count towards the forgiveness under the IDR plans. Okay, so let's look at how all these plans compare to each other. So in this example, we're using the same one as before. 62,000 in income. This time it's a family of 4 in California. Only the actual borrower has loans, their spouse does not. They owe 60 grand and they have a 5.5% interest rate. So this is what the loan simulator tool would spit out if you entered that information in. So under the SAVE plan, the borrower's monthly payment would be $0 right now. Now, the calculator assumes that your income is going to go up by between 3 and 5% every year. So it's assuming that your payment will also go up, and eventually it could be as high as $425. So if these assumptions all stayed the same, the total you pay back would be out of pocket would be 35 grand. And you'd end up getting forgiveness after 20 years. So that would happen in July of 2043, and you'd get about 55,000 forgiven. Under the 10-year standard, you'd have a monthly payment of $651, and you'd pay almost 80 grand out of pocket. ICR would be 533, and you wouldn't get any forgiveness. You'd pay back 82,000. So this alone for this borrower would be a no-brainer. What the amount that not only gives them the lowest monthly payment, but has them pay the least out of pocket over time would be the SAVE plan. Now, if their income jumped way up, that could change. So they'd want to reevaluate reevaluate and rerun their numbers. Just to show you what it looks like. The other payment plans under the graduated repayment plan, which is interest only for the first couple of years, initially their payment would be $370, and at the end it would be $1,100, and they pay back 82 grand. Pay as you earn would start off at 142, so that's sort of the second lowest monthly payment. And because they have all under, but they still would pay more over time. New IBR would be the same as pay as you earn. The extended repayment plan would be 368, and extended graduated would start off at interest only at the 274 and gradually go as high as 578. But again, you can see with all these plans in this scenario, SAVE is the lowest for this borrower. But what happens if their income goes up to 120,000? You can see the answer becomes very different. In this scenario, the SAVE plan, yes, their monthly payment is 438, but assuming their income is going to go up over time, it's actually the income contingent or a close second with pay as you earn or the standard payment plan that actually has them paying the least amount over time. And the forgiveness component goes away. Again, as I've said over and over again, don't get caught up in the word forgiveness. You want to run the numbers to see which payment plan is going to cost you the least amount over time. Now, if none of these payment plans work, you can ask for forbearance or deferment. Interest is going to accrue in many cases, and in most of these cases, it's also not going to count towards forgiveness. Any payments you make always go to outstanding interest first. Interest that's accrued up to the date that you made the payment, and then anything over and above that goes to principal. There's never a payment for paying extra or early, and you can change payment plans at almost any time. How are we doing with questions, Addison? You might be
So we've
unmuted.
actually been fairly slow today, but I did want to bring one to your attention. A good question about the forbearance periods with the July 1st, 2024 implementation of counting towards PSLF. Will that count for forbearances before that or only after that date?
That's a really good question. I've sort of mentioned it in passing, but we haven't had a lot of time to talk about it. There's something called the one-time account adjustment, and they're starting to process it now, but most borrowers won't see it affect their account until maybe as late as the end of next year. But they're essentially giving people credit towards the income-driven plans for all periods of repayment other than default, regardless of what payment plan they were on. And if the borrower had what they deem to be excessive forbearance, and by that, they're defining that as a borrower who had at least 12 consecutive months of forbearance or a total over the life of their loan of 36 months or more. They, under that one-time account adjustment, in those cases, they'll count the forbearance as well in the past. Going forward, however, with the exception of that military forbearance or that rehab forbearance, they're not going to count any future forbearances towards the one-time account, towards IDR forgiveness or towards public service loan forgiveness. By the way, for that, just because this is a common question, that one-time account adjustment, I do, again, encourage everybody to go into that link and read up on it. But there's no application for that. If your loans are eligible for it, which if you have direct loans, they are, it's just going to happen. They've got like tens of millions of accounts to go through. So that's why it's going to take so long. They're going to do it in batches about every 2 months between now and the end of next year when they expect to finish. So as we get ready for payments to start in October, here's a couple things that everybody should be doing. Log on to the Department of Ed's website, which is studentaid.gov, and make sure you know who your loan servicer is. 17 million accounts change servicers over the COVID pause. From there, log on to your servicer account. Make sure they have your correct contact information. That's snail mail, email, phone, owl, passenger pigeon, whatever your preferred method of communication. While you're there, check to see what payment plan you're on and check to see what payment amount it is. And if you need to change, use that loan simulator at studentaid.gov to see what the best fit is for you. If you want to be on automatic payments, which by the way gives you a 1/4 point discount in your interest, you can apply for that through your loan servicer's website. If you were on it pre-COVID, it's not going to automatically start back up. Now, if your loans are in default, there's something called the Fresh Start program that we give a link to as well that can pretty much get you out of default immediately, but it's limited. You're only going to be able to take advantage of the Fresh Start program through the fall of next year. And you just want to make sure that you read all the things. Now, listen, things are going to be pretty chaotic for a while. We've got 40 million plus borrowers, all re-entering repayment at exactly the same time. and just the system wasn't built for that. The servicers in the Department of Ed prepared as much as they could. Um, Unfortunately, Congress did not give the Department of Ed any of the additional funding they asked for to try to help the servicers staff up on this. So they don't have increased staffing. And even if they did, again, there's just, you can't prepare for every one of your customers all coming in the door at exactly the same time. So we're already seeing the volume is incredibly high. I'm seeing people waiting 2, 3, 4, 5 hours to talk to someone on the phone. It's taking longer to process paperwork. And there's been some hiccups here and there. And we're going to see that for a while. Because of that, the Department of Education is trying to create as soft a landing as possible to make sure that borrowers aren't, as much as they can, be negatively affected by any of this. So in that regard, even though payments are due, if payments are late, borrowers are not going to see a delinquency reported to their credit bureau through September 30th of 2024. Now, normally, if you're 90 days delinquent or more, they're reporting you to the credit bureau, and then default is at 270 days. That's not going to happen either. Essentially, what they're going to do is if you become close to 90 days, my understanding is they're going to basically put an automatic forbearance on the account to make sure that you don't default or get reported within this window of an on-ramp. Now, that doesn't mean you're not due for payment. You're going to get delinquency notices. You're going to get delinquency phone calls, but you're not going to get reported. You're not going to have any late fees and so on. So this is not an extension of the pause. Those months also won't count for PSLF or IDR if you don't pay. And if you have an interest subsidy under any of the income-driven plans, and don't pay, then you won't get that interest subsidy. Of course, the exception to that are people that have a $0 payment under those income-driven plans. Of course, interest began accruing on these loans on September 1st. So one thing of confusion is I see borrowers who have a $0 payment under the income-driven plans go, hey, why am I seeing interest accruing? Well, that's because you're not really technically on that income-driven plan until October. So if you have a $0 payment under SAVE, you're still going to see interest accruing in September, and it won't be covered because your SAVE plan doesn't really start until October when payments actually start. The other thing is if you have interest that accrued prior to COVID, that's going to be sitting out there and will need to be paid by you before any money can hit the principal. Nobody's going to be due to recertify their income-driven plan until at least February or March. If you're showing due to recertify before that, they're going to push you out a whole other year. You're also going to be allowed to self-certify your income for the first 6 months after COVID payments. Now, I caution you to make sure that you are still giving the correct income information if you're self-certifying, because you're signing that form under penalty of perjury, and they do background verification and audits. Okay, I ran over a little. I apologize, but there was a lot to cover. Here are the resources that I talked about. Sort of the two main ones you need to remember where you can find all the others are studentaid.gov and freestudentloanadvice.org. I'm happy to hang out for another couple minutes for questions. Addison, I didn't know if there were any others that you thought I should cover.
No, quiet group today.
Oh, you guys took it too easy on him.
Thank you, Betsy, for key information of what to know about student loans restarting. I am now going to provide an overview of how U.S. Senator Casey's office may view assistance to constituents regarding student loan issues and navigating federal agencies. Next slide, please. Senator Casey's Office for Constituent Services consists of a team of constituent advocates who assist constituents who are experiencing issues with the federal agency. This includes, but is not limited to, Social Security benefits, emergency passport, IRS problems, veteran affairs benefits, immigration snacks, SBA concerns, and more. After receiving written permission, our office is able to follow up with the federal agency on a constituent's behalf and relay information and concerns and demonstrate U.S. Senator Casey's interest on the matter. Under law and rules of the U.S. Senate, we cannot force a federal agency to act in someone's favor. It is important to note that if we cannot provide assistance, such as with state or private entities, we can refer constituents to someone who can best help. Next slide, please. With regard to student loans in the U.S. Department of Education, we can reach out to the U.S. Department of Education on the constituent's behalf to try and assist with a variety of matters, including application for loan forgiveness programs, statements of loan payments, and communication with your federal loan servicer. The most common Department of Education questions are related to the Public Service Loan Forgiveness Program and loan repayments. Next slide, please. If you would like to request assistance from Senator Casey's Office of Constituent Services, either with the U.S. Department of Education issue or for an issue with another federal agency, please do not hesitate to contact our office at 717-231-7540 or toll free at 1-866-461-9159. You can also reach out via Senator Casey's website at www.casey.senate.gov/contact/assistance. This webinar was recorded and the recording will be shared with everyone who registered. We thank TISLA for partnering with U.S. Senator Bob Casey's office and sharing resources. We will now close out the webinar and thank you for attending.